Good morning, everyone. Welcome to our budget speech webinar following the budget speech on 22 February, happened on Wednesday. So joining us is Pieter Janse van Rensburg. He's from AJM located here in Cape Town. So the Baker Tilly Greenwich firm in Cape Town, we do a lot of work with AJM during the year, and we are thankful for Pieter for putting some time aside to present us with a summary of the budget speech and I think some detail on the more interesting aspects that were mentioned. So I'm going to hand over to Pieter now.
Yes, Johan, thanks very much. Good morning, everybody joining. I understand that we have participants from all over the country. So welcome this morning. I have the unenviable task of entertaining you for the next hour on a budget speech that left much to be desired. Over the last couple of days, there's been plenty of back and forth and commentary around that, and really the budget commences at 2 o'clock, it ends at 3 o'clock. By 6 that evening, it's old news already. So over the last day and a half, you would have heard all the commentaries around new solar incentives for individuals and a little bit of bracket creep adjustments, inflationary adjustments for excise duties and all of those more pertinent facts. So what I'm going to try to do today, and we're going to try to restrict it to about 45 minutes and leave about 15 minutes for questions. You're welcome to pose your questions as we go through to Johan as well, and he'll interrupt me and we can answer the questions as we go along. But just give you a sense all of those comments together, just to give you a little bit more substance to what the nuances were in an otherwise rather bland budget. Of course, the 45-50 minutes that the minister spends on budget day is only a very shortened version of the actual budget, and most of that is a part of welcoming and thank yous at the end. But if you start delving into the into the budget documentation, there's about 1,500 to 2,000 pages that supports all of this. And those consist out of the detailed expenditure per government sector, per province, per particular minister for that where their funds will be allocated. It also contains all the detailed tax proposals that will be part of the next legislative cycle, or that we assume at least will be part of the next legislative cycle. So there's typically always this scenario in South Africa where we just really have 2 months worth of transactional certainty. And the reason for that is the way our budgeting and legislative process works. On Wednesday, we had the budget, and some tax proposals are hinted at that already. So, and now from February until middle of July, it's a bit of a twilight zone really, because we know in the budget certain things have been said, but we're not quite sure the exact direction we were headed with those proposed amendments. Only come the draft bills in July do we exactly know what is intended. And the problem then is most of those that, especially when it relates to anti-avoidance provisions, are backdated effectively the date of the budget speech. Then the whole legislative process unfolds until the final act gets promulgated in January only of next year. So the only time we have transactional certainty is from January when the act gets promulgated until its budget speech again. So we are now entering that period of grayness, uncertainty on that. So what I'll try to do is touch on those specific tax proposals that are also that were also part of the speech that the minister obviously didn't speak to. Some of them are a little bit more technical, and I appreciate the fact that he doesn't speak to them in the speech itself, because it's simply not applicable to the broader public, or becomes overly technical and not really something that they need to address at that forum already. But we'll try to touch on those as we go along. Ladies and gentlemen, the first thing that really struck me, I just want to touch on those 2 comments that on the introductory page there. We are tabling the 2023 budget in difficult economic and global environment. Domestically, load shedding has become more persistent and prolonged. The one at the bottom, we're navigating this difficult environment with policies that support faster growth and address fiscal risk. Now, this was on Wednesday. This might have well been in 2022, 21, 2019, 2018, 2016, 2017, it could have really been in a year. So it's really the generality of those comments and the circumstances that the minister says we are doing this budget. It's really it's nothing new, nothing original. We've had load shedding since 2007, 2008 already. There was a short break, but in the last couple of years it's been pertinent again. So really, again, this is all old news. Difficult global environment, threatening the survival of businesses, addressing fiscal risk. Business as usual. It's things that we've heard again, and that's really the trend of the entire budget. We didn't see anything significant in his comments, and it's just much more of the same on that front specifically. So no real red flags at this stage, just in terms of his introductory comments. And yeah, very much business as usual on that. On the screen now, you can start reading through those. In the background are some of the highlights of the budget. But what I want to perhaps touch on before we delve into what was actually said is what was not said. And often there's a lot more in there to read in there on what's not said in the budget than is what's said in the budget. The first thing that they touched on, but didn't quite give us an indication of where we're headed with this, is the social distress grant. We know that the old age grant and the children grant and the old age pension, all of those will be increased come the 1st of March with a couple of rand, 90 rand in the case of the old age pension, and then on the 1st of October with another 10 rand. So the ordinary grants become known to them. They will increase in line with inflation and the necessary adjustments. But the distress grant was something that was specifically implemented by government as part of the COVID relief package in 2020 already, 350 rand a month for qualifying persons. Now, that was initially extended into 21, into 2022, and now we're heading into 2023, where this social distress grant is still being extended and put in place. Yes, admittedly, it hasn't been increased with inflation or any other significant adjustments. It's remained at 350 rand, but it is still being extended. My hunch when it was originally implemented was at that stage already that these are the first signs for a permanent basic income grant, and I'm now even more convinced that that is perhaps the area that we're headed in. Why are we still having a debate about the social distress grant and not a basic income grant? I think it's just a mask of where we're headed with this, really. The only problem government's facing now is how must we fund it? Where must the money come from? So I don't think that it's really, because there's simply no justification in having this social distress grant anymore. COVID's all but gone. Yes, we're still feeling some of the knock-on effects, but the bulk of the effects have been felt and washed through the system. So I think this is just masking of the first steps into a permanent basic income grant. The funding of that, well, a couple of things that have been hinted at. Higher personal taxes. I don't see it being funded from that. If you look at South Africa on the Laffer curve, there's simply no more room to tax the upper income earners on that. I want to touch on wealth tax. When we delve into the detail, that was also something that was hinted at. The only thing that it can really be funded from is through the expansion of the tax base. And the only way South Africa can expand its tax base locally to fund that is really through the indirect tax system, through the VAT system, because that affects all South Africans. All 60 million South Africans form part of that tax base. When you acquire goods or services, you contribute to that tax base. So it's not on a proportionate sliding scale where you tax the upwards. The tax base is a lot broader. Why not increase the VAT rate? Not popular from an from a political perspective. Simon Brown, the well-known financial commentator, mentioned earlier in this week that this budget is really a quasi-election budget. So the government really try to find a midway between just buying enough time to perhaps being re-elected in 2024, because really the February 2024 budget doesn't provide them with enough time to do that. So this really is the quasi-election budget. So that's why I think that the stress grant is there and thereabouts, and it's not going to completely disappear off the radar. National health insurance. There were 3 or 4 years where national health insurance was on top of the agenda, how this was going to be funded, what we're going to do with it, making free free medical care available for all South Africans, the use of private medical aids no longer being necessary, all of that, that has really become quiet, and it concerns me slightly, because I'm not convinced that it's completely off the agenda. I think, just given the challenges that we're facing now, in terms of the state of disaster, Eskom, electricity supply, all of this, it's just slightly dropped down the agenda. But if we just look at overall cost implications, the 260 odd billion rand of debt that Eskom debt that government is assuming now, I think the national health insurance is going to it's going to be, the Eskom debt is going to be a shadow in relation to that. So where are we going to fund that from? So nothing was said around that. E-tolls. E-toll is the government, as well, the local government in Gauteng has at least indicated that e-tolls will be scrapped now, but there is a lot of money still to be paid back to creditors of the e-toll system. So how is that going to be funded? Yes, it is a Gauteng provincial issue, but if the Gauteng province doesn't have the necessary funding to entertain this, the National Treasury will have to step up and do it. Nothing was said around that. The big omission for me this year, and it's one of, and as we go along, you'll appreciate my frustration with this, but is the lack of information around exchange control. 3 or 4 years ago, we had the wonderful news that this new capital flow management system will be introduced, where all transactions will be allowed unless there's a specific prohibition on certain transactions. Now it's 4 years in, and we simply haven't seen anything. So the default position is actually still that all transactions are disallowed unless it's specifically approved by an authorized dealer or by the South African Reserve Bank. Exchange control is 100 years old in South Africa. It simply does not have a place in South Africa anymore. It is stunting economic growth. Foreign investors do not want to come into South Africa for fear that they can never get their money out. So exchange controls simply defeats the purpose of what we're busy with. Later on today, we'll get the final decisions about grey listing of South Africa for money laundering purposes from the Financial Action Task Force. So if we already have all of these regulations in place, exchange control, FICA, everything that the bank obtains from you before you open a bank account, all of these regulations, and we're still heading into a scenario where we're potentially being grey listed. It just shows you those regulations simply don't work. The regulators are there, rules are there, but even that is not enough. So to avoid grey listing. So if we see that it doesn't work to address that, then simply why do we still have it? In my view, it's one of the biggest stunters of economic growth and transaction flow in South Africa, and it simply doesn't have a place anymore if we want to remain globally competitive. So unfortunately, nothing said around exchange control, especially for the crypto arbitrage pundits around there. I was hoping for some exciting news on that, on FIA pins and all of those type of things. Nothing, unfortunately. The Reserve Bank and SARS are staring at each other, and neither organization knows which is going to take the next step in driving this, in addressing the issue. So I'm very, very disappointed on that. Another thing that the Minister didn't touch on, but really spills over from the previous budget, is the reduction in the corporate tax rate. We know that for March, for years after the 1st of March, next week, the corporate tax rate has been reduced from 28% to 27%. Now, many people ask, but listen, why not more? Why aren't we heading to 26? Why aren't we heading into 25? It'll be positive for growth. It will create a positive investment sentiment. And the problem is, at this stage, while we can't reduce it further, is that we don't have the tax base to support that. The money has to come from somewhere. The 30-odd% of revenue that is contributed by corporate taxpayers, that 1% reduction is a significant amount that is lost to the fiscus. So we must fund that somewhere. So where was that funded in the previous round when we went from 28 to 27%? Primarily two things. The first was the introduction of additional interest limitations, especially cross-border interest limitations. We have acquired funding abroad and pay out interest, so certain restrictions on that. And the second one, which I think is much more relevant for all of our purposes, is the limitation in the degree to which you can utilize assessed losses. So remember, from next week, the regime around assessed losses changes. How does it work currently? Where a taxpayer has a balance of assessed loss, so assessed loss is something that's incurred in a current year. A balance of assessed loss is something that's carried over from a previous year. So as we stand now, as long as the company keeps on trading, it had economic activity during the year, it traded, you are allowed to apply your balance of assessed loss carried forward from the previous year, unrestricted, unlimited. The assessed loss is available for you. How does it work from next week? And that's exactly why why it's only applies from next week, is from the reduction of the corporate tax rate as well, is because that the assessed loss mechanism funds that reduction. So there's a de minimis level of R1 million. So the higher of R1 million or 80% of your balance of your assessed loss, you are willing, you are capable at least of applying to your taxable income in a specific year. So effectively, if we ignore the de minimis provision for a moment, it effectively means that irrespective of whether you are in assessed loss position or not, you're going to pay tax on at least the first 20% of your profit in the current year. So even if you have a assessed loss carried forward, there will still be some cash tax outflow on that. The upside, at least, is that we don't lose the balance of assessed loss that you don't apply. You can carry that forward. There's no restriction or no limitation on when that expires. So the assessed loss will always be available for you. It's just the degree to which you can apply that assessed loss in the current year that is troublesome. We will only be able to apply 80%, apply the balance of assessed loss to 80% of the taxable income, which effectively means 20%. So that was also missing. Let's just quickly look at the.
Sorry, Peter, just to quickly interject there. Just a bit of a technical question. So, firstly, I understand that if a company makes an assessed loss in the current year, so they won't pay any tax, or let's say it's a 31.
Okay. Yes.
They won't pay any tax in that case, and then that assessed loss just carries forward with the rest of the assessed loss balance.
Quite right. It becomes part of your balance of assessed loss. Then quite right.
Okay. And then just another point. So Section 18A deduction. So let's say in the past, a company made donations that are deductible in terms of Section 18A. And then these basically carry forward because every year the company made a loss, a tax loss. So they weren't able to deduct the donations, that just carries forward. So let's say we are in a scenario where a company makes taxable profits. They can only apply 80% of that taxable profits of that portion of their assessed loss. So technically they're going to be taxed on 20% of taxable income. Can they still then use past donations to reduce that amount?
Yes, I don't think I haven't looked at it specifically, but I can't see that that position changes at all the assessed loss provision, because the amendment to the assessed loss provisions deals only with your availability of applying a balance of assessed loss. So once you've applied the balance of assessed loss, and there are other mechanisms available for you to reduce taxable income, such as 18A and all the rest, those mechanisms will still be available for the taxpayers.
Yes. Okay, and that would also include something like maybe capital development expenditure.
In the case of for farmers, for example, on the first schedule, capital development expenditure, yes.
Okay. Okay. Thank you for that.
Okay. Excellent. So if we look at the overall, what highlights slight decline in the projected on the consolidated budget deficit from 4.2% to 3.2%. Ironically, if we strip out of that South Africa's interest cost, the cost of government debt, the cost that we are servicing, we would have been in a budget surplus. For the first time since when Trevor Manuel was still finance minister, we would have been in a budget surplus position. But what's causing our problem at this stage is our interest-bearing debt. South Africa's cost to service its debt is R1 billion a day. 1 billion rand a day just in interest cost. We're ending up with 360 billion rand a year just to service our debt. So that's why all of these talks around fiscal consolidation are so relevant. But yes, we've seen fiscal, or at least proposed fiscal consolidation over the last 10 or 15 years. But now suddenly we're taking on 256 billion rand worth of Eskom's debt, which just erodes all of that progress that has been made. So that is really our problem. lack of economic growth and the huge government debt, interest-bearing government debt at this stage. R1 billion a day, we simply can't move forward if we're spending R1 billion a day on. Then matters like the Tottenham Hotspur sponsorship really becomes irrelevant. If you're spending R1 billion a day on interest, things like that really become irrelevant. GDP, I'm slightly concerned about that. And the reason for the concern is, yes, it's low, but more concerningly is that the different views that we're getting from government at this stage. That's National Treasury's proposal, the 1.4 compared to 1.6 in October. But the South African Reserve Bank has a totally different viewpoint on it. They're estimating 0.9%. So the right hand isn't really talking to the left hand. Which figures must we really then must we believe? So it's difficult because decisions that government are doing are based on this 1.4%, and the decisions that the Reserve Bank are making for interest rates are depending on a 0.9%. So there seems to be inconsistency on the information, at least that we base our decisions on. Really concerning. Total consolidated spending over the next 2 years, close enough to 7.1 trillion rand. That is an extremely large number. I mentioned the debt servicing costs up to 340 billion rand, close enough to R1 billion a day. You have seen the adjustments for personal income tax and transfer duties, slight relief just in terms of bracket creep. So the theory behind that, if everybody's salaries increased in line with inflation, then the bracket creep would have adjusted for that. So economically, at least, you would have been in the same position. Slight increase for transfer duties. The 4 billion rand relief for renewable energy, we'll touch on that somewhat later. And already mentioned the Eskom debt relief proposal of 250-odd billion rand. So for consumers, the ordinary man on the street, you and I, what have been the issues? I mentioned the adjustments in bracket creep, medical credits, that type of thing. Salaried earners will be effectively in the same position. So that's good news that it was extended. What about wealth taxes? I'm not concerned at all about wealth taxes. South Africa is not in a position to levy wealth tax at this stage yet. We already have capital gains tax, which is a form of wealth tax. We already have estate duty, that is another form of wealth tax. We don't have a separate wealth tax that is needed at this stage. We also don't have, number one, the data on which to implement it. So even if we did decide to implement, it would be a foolish decision because we don't have the data to support it, what the additional revenue will be. And then the biggest challenge, in my view, is practical. How do we report that? How do we value it? How do we value immovable property in Cape Town versus Joburg? Is it willing buyer? Is it willing seller? Is it market value? And how often will it be taxed? What are the consequences? Will it get stepped up in base costs? Those type of things. So we don't have the practical mechanisms to enable us to implement this, number one. And number two, we don't have the data to support a logical reason to do that. So wealth tax off the table. I don't see, at least for the next 5 years, that wealth tax will be a concern for taxpayers. I was really surprised about the road accident fund levy and the general fuel levy that wasn't increased. We saw a similar scenario last year with no increase. I thought that given the relief last year, we would have been taxed this year, but no. Fortunately, nothing there. The foreign remuneration income, that levels remain unchanged. Slight increase inflationary on the excise duties, on the sin taxes of close enough to 5%. Let's talk about the rebate for a moment on solar, the cost of solar for households. So my first comment around that would be, yes, it's positive. Government recognizes that households are doing a lot to be self-sufficient, to assist in generating capacity, and they want to assist them in that regard. So that's good news. My view is that we unfortunately missed a golden opportunity here to really make a big impact. 2 weeks ago, as part of the State of the Nation address, President Ramaphosa announced this relief mechanism. And my feeling is almost as if the Treasury scrambled in those last couple of days to put together something just to appease the President. It wasn't well thought through for a couple of reasons. Number one, the mechanism that they're using is in terms of a credit and not a deduction. So if they would have provided a deduction against taxable income and not a credit against a tax liability, I think the benefit would have been a lot bigger for taxpayers. We saw the same a couple of years ago when medical aid credits changed. You used to get a deduction for your medical aid contributions, but now it's a medical credit. So the reason why they did that is the relief is pushed a lot more towards the lower income bracket, and the higher income brackets really suffer as a result of that. They're not getting in rands and cents with the same benefit. And this is exactly the same. So I think firstly, a deduction mechanism would have been a lot more beneficial. The second problem is that it's only for a year. It's only been made available for a period of between the 1st of March and 28th of February next year, so really limited scope. The 15,000 rand, a year maximum is also very restrictive. So it's 25% of your actual cost, but then limited to 15,000 rand. So for you to qualify for the full benefit, you would have at least had to spend 60,000 rand on that to be able to qualify for the full benefit. And my biggest concern with this is it's not assisting us in generating, or well, enabling people to generate electricity. And the reason why I say that is because it's a deduction mechanism, and bear in mind that you'll only get the benefit in 18 months' time. So if you spend it during the course of the 2024 year of assessment, you only file that return in August of next year. So is we are just now rewarding people that have already expended money on installing solar panels. We're just saying, well done, thank you for installing it. We're not enabling people to do it. The persons that have already done it has the financial means and they've done it great, and that's wonderful. But we're not enabling more and more people to do this. What would have enabled people to do this is reducing the cost of it by a couple of things. Scrapping all import duty on anything related to energy generation whatsoever in the country. No import duties. They could have considered this making similar to what we have for basic foodstuffs, a zero-rated VAT for that, so we don't have any VAT leakage on that as well. And then a basic subsidy that could enable people rather go to government and say, listen, give me my 15,000 rand now because I want to do this. I don't have the money to finance this. I can't do it. So finance me now, reduce the cost, and then I'll be able to install this and get it off the grid. So the mechanism is really just a thumbs up for the people that have done it. It's not really assisting in adding additional capability to the grid. And remember, only on solar panels. And it's not for inverters, not for batteries, and all of those things that are actually critical to the system as well. I understand their reasoning for not including inverters and batteries in all the rest because those can run independently of the solar. So to a degree, I appreciate that. But goodness, when in a crisis, we stage 6 load shedding 6, 7, 8 hours a day that we don't have electricity. Surely we can't be as short-sighted around that. So yes. Good thing the solar this question around this the solar benefit, but I think we missed an opportunity there. Just in terms of a couple of questions that I've received around this, what about my Airbnb or the flat that I lease out or the room in the back that's leased to somebody? We haven't seen the draft legislation yet, but my inclination is that what they will do is that the majority of whichever building this is put on, the majority must be for residential use and no trading activities. So Airbnb flat in the city and wherever, I think that will be excluded. There will be mechanisms to exclude that from the trade. So this is only going to be for resident and most likely try to link that to the primary residence concept as we have in the 8th schedule. So I have my suspicions around that. If you are at all uncertain on whether you want to install it on the rental property that you have or Airbnb, my suggestion would be wait until we get to the draft legislation later in the year, July, August, in that area. because we don't know yet whether my suspicion is that it won't qualify, but let's see until July where it goes. So if you are all thinking along those directions, just be very careful, because it might be that you won't qualify for that. Let's quickly look at the corporate tax income proposals. Practice note 31. Many of you would have seen last year that practice note 31 might be withdrawn. Oversimplified practice note 31 says, listen, if you have interest income and interest expenditure, then we will allow you an interest deduction, but limited to the interest income. And that's especially where there's no trading activity. So one of the requirements to get any deduction for income tax purposes is that a taxpayer must trade. So even there we don't trade. Practice note 31 acknowledges, we see that there's no trading, but we'll allow you the deduction nonetheless. So the proposal was that it would be withdrawn. SARS is really looking at this. Really, really good news. I think this is positive. I think they will still withdraw, but I think there will be legislative amendments that will address the withdrawals. That's at least coming. A couple of more technical aspects. Interactions for provisions around asset for share transactions. These are all just technical corrections. So if you at all have enter into corporate rollover transactions, either Section 42 asset for share transactions or unbundling transactions, those are slight amendments that are made. So the mechanisms will still be there. It's just technical corrections and uncertainties that are being clarified as part of that. The same goes for interest limitation rules. The renewable energy incentive, 125% deduction in year one. This I think is a good one. The residential one, I have no issues with that, but the renewable energy incentive, I think this is a good one. We already have the existing regime, Section 12 capital B, that allows for 50, 30, 20 deductions, similar to farming activities. Once you start using your assets as part of a trade, this will, and they are under the current regime, there's also limitation on generation power, and generation capability, and the wattage that you create. In terms of this new proposal, unfortunately only for 2 years, but nonetheless, 125% deduction for all renewable energy projects without any imposition of threshold generation capacity. So I think this is very, very good. Corporate tax incentives, I think we're wasting our time with this. The Section 12H learnership allowances, industrial development allowances, the allowances for energy efficiency, all of these. I think it's a distraction for National Treasury. I think it's a distraction for SARS. Taxpayers aren't getting benefit of that. The systems are open to manipulation, to abuse. So I really, the incentives that they've extended now, for me, it's really not as beneficial, and I'm not immediately certain that they should carry. Excuse me. Let's talk about value-added tax for a moment. The one trick that I think we did miss again this year, excuse me, is for the increase in the minimum threshold for registration. We've been at the R1 million compulsory registration for probably 15, 20 years already. For me, that is also another, ironically enough, the lower that level, the more I think economic growth is stunted and small businesses are killed because of that. Because the additional 15% once you reach R1 million threshold is for on an informal business with paper thin margins is significant. It makes them 15% less comparative to the big corporate client. So it simply doesn't make sense. Yes, R1 million is a lot of money, make no mistake, but in the sense of business, providing jobs, creating opportunities, it's comparatively low. So why are we still sitting with a level so low where people are actively trying to avoid registration, either simply ignoring it, not registering at all, or trying all sorts of clever tricks by splitting operations into different entities and all the rest? And that is ironically enough where most of SARS's resources go into VAT audits are these small and medium enterprises. My view is that we must just raise the minimum registration threshold to R5 million, I would say even R10 million, to reduce that compliance burden of the revenue authorities and make small and medium enterprises that much more competitive. Really disappointed that we didn't see anything on that. Specific VAT amendments that are proposed in the short-term insurance industry, but these are very specific type products. So I think for the man on the street, everyday consumers that have an insurance company, short-term insurance, I don't think there's going to be anything around that. Prepaid vouchers for those of us on prepaid solutions for telecommunication. Again, some technical corrections there. MTN was in a dispute with SARS last year, and these corrections are as a result of that MTN judgment, where technical corrections are made on the value of vouchers that are issued. Again, not something I think that the consumer will necessarily experience, but if you operate in the telecommunications industry, have a look at this. It might be relevant for you. Property developers, there's where there's temporary letting of commercial properties, of property development. The VAT access theory says you must have a change in use and account for output tax, because you're now no longer making a taxable supply in the form of selling a property. You're now making an exempt supply in the form of making available of residential accommodation. So the VAT inputs that you claimed on the actual construction of the building must now be reversed and paid as an output. The proposed amendments here is just some clarification again on which costs are subject to the amended VAT output or not. So if you're at all in the property development space and there is temporary residential letting, just be aware that there might be some proposals around that as well. Carbon tax is very specific. So I don't want to stand still on that for too long, but there are some rate adjustments on carbon tax as well. Individuals, employment and savings. We already talked about the solar incentive. Yes, it's good, but yeah, not convinced that we optimally use the opportunity that we had now to really make an impactful difference on that. Cross-border income tax and cross-border and exchange control. Slight technical corrections on tax-free investment accounts. Those of us that have tax-free investment accounts, and also from a capital gains tax perspective, where you cease to be a resident, those contribution rates that you have here will now be apportioned for a period where you were a resident and were not a resident. Now, it just baffles my mind completely on why National Treasury and why SARS are focusing on such small things. 33,000 Rand a year. If somebody leaves, it might be 15 or 16,000 Rand contribution that they forgo. It's chump change in comparison to the real issues that there are. So they're spending their time on inconsequential amendments, which is rather silly. And that's also why the individuals deductions for the solar is such an issue for me. Any of us that tried to claim home office expenses during the lockdown period would have experienced an enormous amount of pushback from SARS and queries and back and forth and disallowance of expenditure. And I foresee the same with the solar incentive. All the administration, Treasury has a policy. They introduce a concept, but the administration is then pushed back onto SARS and the consumer, and it's simply the wheels come off there. So. Yeah, and this is much more the same thing, focusing on the incorrect behaviors. Some anti-avoidance provisions around the receipt of foreign dividends and all of those type of technical corrections. The one big thing that is also as a result of a case that was in the Supreme Court of Appeal back in last year, the Thistle Trust. It was a October or November case. Is the taxation of non-resident beneficiaries of trusts. As the legislation stands today, income can be distributed to non-resident beneficiaries. Income in the form of interest or rental income or dividends or ordinary type of income, but capital gains are restricted to be taxed in the trust. So you can still make the distribution. The tax consequences just accrue to the trust. So if you have South African trust with Namibian beneficiaries or brothers and sisters or parents that are in Australia now, and you might want to make distributions to them, currently you can still make those income distributions, but not the capital gains tax distributions. Now this came to the fore as part of the Thistle Trust judgment in of last year, and what they're trying to do now is the same restriction that applies to the distribution of capital gains will now apply to income as well. So in other words, you'll still be able to do the distribution, but the income tax will be captured in the trust. So the trust will account for the income tax consequences. And whether you want to make the distribution then really becomes, I think, inconsequential, because the tax consequences already accrue to the trust. And you're in any case going to have a problem from an exchange control perspective in externalizing the funds to the foreign beneficiaries. So it's really going to be troublesome to do that. Is this a good thing or not? I'm indifferent to it. It contributes to the South African tax base. It broadens the tax base. I don't necessarily see that it's against policy, because we already have it for capital gains tax purposes. Be very, very careful though. If you did want to perhaps make distributions to non-residents now already, my suspicion is that once the bill gets published in late June this year, that restriction will be made effective from the date of the budget speech. We've seen that plenty of times before with the introduction of Section 7C, with the dividends tax stripping provisions, where there's an anti-avoidance provision that is intended to be imposed, and that provision can cause immediate outflow, a so-called rush on the bank. Then they make that restriction applicable from the date of the announcement in the budget speech. And I assume this is going to be the same. So if you did want to make distributions to non-resident beneficiaries now, be very, very careful. I would suggest, again, waiting until we have the bill in July of this year, then you'll be able to make an informed decision, because you might be in a situation where you make a distribution now in anticipation of the legislative change, and then you are actually already caught up in that provision. So rather wait. You'll be no worse off if you wait until the amendment has been made. Unless, of course, in that case, they make it effective from the date of the promulgation of the bill. So it's really so difficult to estimate whether this will be retrospective from the date of the budget speech or effective the date of promulgation of the bill. It's difficult to advise in those circumstances. My suspicion is that they'll make it effective from the date of the budget speech already. So just be very, very careful if you do intend to make distributions to non-residents at this stage. A couple of things around participation exemption for cross borders. Another one, interesting enough, that comes out of a judgment now very recently, 3 weeks ago, the coronation judgment. Well, this deals with CFCs, but there are other CFC adjustments as well that relate to that. Is the tightening of legislation around CFC, specifically foreign business establishment exclusions. So lots of tightening up around CFC. So if you're a South African operation with holdings into foreign jurisdictions, and those with subsidiaries, especially in foreign jurisdictions, and those are controlled foreign companies, be very careful. There might be significant changes around that. Crypto assets, we've seen this for so long. Reserve Bank is working with Treasury to enhance monitoring and reporting of crypto assets transactions. We've heard it before. I'm not convinced that that they're giving this the due attention that it needs. It's become so part and parcel of economic activity in South Africa. This is super urgent. So I really do hope that the comments that are made here aren't just superficial, and that we really take action on that. Then administrative proposals. You would have seen now from the last couple of pages that we've gone through that there's some technical corrections and a couple of tax substance matters that have changed, but the real progress, at least, that we see in our tax legislation is around tax administration. So we have Substantive Tax Act, the Income Tax Act, the Value Added Tax Act, the State Duty, SDT, all of that. But then you have the administrative provisions that run around that. And that's where we see a lot more legislative amendments now recently. Now, I think that's an indication that our tax system is settled. It's become mature. It's grown up now. So we don't need so many substantive tax changes. We have the legislation. Let's now rather focus on enforcement of the legislation, on the administrative proposals. One of the big things that I see coming in future, third party administration reform. You would have seen now when you register trust, there's a requirement that you must now that you must now also include the ultimate beneficial owners of the trust. Now, this is a concept that spills over from Europe, especially in Austria, in the UK as well, Germany, the Netherlands. There's this concept of ultimate beneficial owner. Even if you look through a trust structure, now, this is where we're headed as well at this stage, is where that SARS has a complete picture of who is involved in which structures. That includes the beneficiaries of a trust, that includes the donors, the settlers, if there are any protectors of trust. So 10 years ago, trusts were blind. You indicated in a tax return, income was distributed, and boom, that was it. So it's been enhanced over time. Now we're in a place where income is distributed. Okay, tell us to which taxpayer has been distributed. Now we're heading into a direction where, okay, but tell me who all your beneficiaries are. How did they benefit? How did they fit into the structure? So third-party data around trust is we're going to become extremely important, and a lot of administration will be pushed back on trustees. So trustees, beware, there are a lot of changes coming. Changes to the process of, around provisional tax payments. I'm very supportive of this. Provisional tax, of administration around provisional tax, and the timing of provisional tax is a huge burden at this stage. So many of the disputes that land in our office are on underpayments of provisional taxes. The whole provisional tax system, timing around that is troublesome. So it's really positive that they're looking at changes around provisional tax. General disclosure provisions for Section 18A organizations, that's also on the count. Non-resident employers, currently as we stand now, only resident employers or representative employers of non-resident employers are required to register for pay as you earn and withhold amounts in terms of salaries. So now if you have a non-resident employer that doesn't have any representative employee in South Africa, we're in a situation where potentially no pay as you earn is being withheld from salaries paid. That's changing. Non-resident employers might also be required to register, especially for UIF and skills development levies in South Africa as well. So look at that. The expanding of the time period in which auto disputes need to be submitted for auto assessments. I think this is, they're trying to look good here. I think it's simply because SARS is using the incorrect legislative mechanism for auto assessments. It simply doesn't work. Somebody made the comment last year, and I agree with him, that SARS is trying to run before they can walk. The mechanism the legislative mechanism that they're using is for estimated assessments. Estimated assessments, very isolated type of events that estimated assessments apply to. It's not built, and the legislation doesn't cater for bulk assessments like these auto assessments. So I think it's because they ran into trouble that amendments are proposed here, but nonetheless, there's some movement going to be on that. And then, ladies and gentlemen, just to start slowly winding down and provide the opportunity for some questions. Well, rates have remained flat. We talked about the VAT rate, dividend tax withholding rate, the same. CGT inclusion rates, the same. I don't really see any scope for increase there, because if we increase, we're already at 80%. If we increase it to 100%, we might as well tear after 8th schedule out of the Act. So I don't see any increases in that for the foreseeable future. Royalty and interest withholding tax still at the same level. The new bracket creep there, tax-free thresholds and all of the rest there. So not much around the actual rates, which I think is positive. So, ladies and gentlemen, that's in a nutshell what the budget was about this week. I mentioned at the beginning that things that were not in there that's of real concern to me. I mentioned the wealth taxes that I'm not really concerned about. There's been so much political, economic debate on where we're actually spending the money. If we just look at the pie chart of where it's going, about 30% is going to education. Lots of debate around that. So much on policing. So how the money is spent is, I think that's really politically driven, and there's in a quasi-election budget, you're always going to have the outliers on that. So the comments that you do read in the media from political commentators, that you do read from economists, see it in context. My overall impression of the budget, I'm positive about the tax changes that are being made. I'm speaking now specifically out of a tax perspective. Yes, there's economic issues and there's political issues and what we're spending on the money, etc., etc. But from a tax viewpoint alone, I'm positive about what we're seeing. It's progressive, a lot more focused on tax administration rather than substantive tax amendments. So I'm positive about the movements I'm seeing. I'm positive what I'm seeing at SARS. So it's not all doom and gloom. It's not all bad news. If we ignore the noise around political consequences and the economics around this, and just focus on the fiscus, on SARS and Treasury, I think there are positive lights, and compliance is picking up. So I think positive, and credit to National Treasury. They've again done well. The three pillars in government that I see as the beacons of hope: National Treasury, SARS, and the judiciary. They're doing excellent work. I fear for this afternoon for the grey listing announcement. I think that only comes out after the JSE closes later this afternoon, but I think the minister also needed to do that we must accept that it is going to happen. He wouldn't have made such a big deal of it as part of the budget speech if we didn't already anticipate it to be. So I think that is going to be unfortunately the case. But yeah, South Africa is resilient. We've gone through downgrades and all of the rest in the past, and we've managed to carry on. And I think it's going to be a very similar scenario this year. Johan, I'm not sure whether I wasn't able to keep an eye on the comments that have come through, whether there are any questions, or whether we perhaps want to open up the floor now for some questions. We have 4 or 5 minutes left if there are any burning questions or specifically comments from our audience.
So, Peter, just for a moment, if we can go back to, I think it was page 5 on the solar deduction for businesses.
Yes.
So just a quick recap. So currently that's dealt with in section 12B, and I understand there's this limitation on the generation capacity. So currently, if you have a solar project with a generation capacity of less than 1 megawatt, then you get the 100% deduction in year 1 when it's brought into use. And if it's more than 1 megawatt, you do the, I think, as you said, like similar to farmers, the 50, 30, 20 split over 3 years.
Yeah.
So I'm assuming this amendment is going to come into that section. It's going to be temporary for this 2-year period, and they're just going to do away with that 1 megawatt threshold, and it's going to become 125% deduction.
John, yeah, I don't think that they're going to that the 12B proposals will be replaced with this. I think this will be in addition to they won't allow you to double dip under both regimes. But I think the way that they'll structure it is that it's they'll either restrict 12B to say you can no longer claim 12B after 28th February this year for new panels. So in other words, what you've already installed, you'll still be able to, and then have this as a new section in its entirety. But the problem is after 28th February 2025, because it's only for 2 years, what then? So I'm not sure what mechanism they are going to use. I don't think they're going to scrap 12B. I think this is going to be, I think, over and above. That's going to be, but we don't know what the mechanism will be. We'll only see that in July.
Okay. So, and then this also means that if there were maybe taxpayers thinking of turning on or bringing their renewable energy projects into use in the next few days, let's say between now and Tuesday, in order to claim that deduction the current year. So if they delay that to, let's say, Wednesday, the 1st of March, they may be able to make use of this additional 25%.
Yeah, Johan, it's unfair really, because what do taxpayers do now? Everybody's okay, but what now? It's difficult. I think it's worthwhile waiting. If at all practically and commercially viable, I think it's worthwhile waiting until we know exactly what this legislation is going to be, because we're heading into that twilight zone now where we don't have any information until July. So what you don't want to do is now miss a step or two in the process that potentially disqualifies you from this. So if you are thinking about it, then it might be worthwhile to wait till we have more clarity around what it will be, to make sure that you position yourself to be able to claim. I know it's not a very firm answer, but it's difficult to estimate what they'll do.
And I think it's also true what you say, that it is a bit of if it's economically viable, because at the moment,
of course, if it, look, tax is always for me the last consideration. If your business is struggling as a result of that, you need it now, then to hang on with the tax, get whatever makes your business run tick over going on. Because if there's no business, there's no tax to be paid in any case. Focus on the commercial, what needs to be done now. But if there is a possibility of weighing up, then it might be worthwhile to.
Okay, and then just the second question on, again, the renewable energy. So I noticed they use the word businesses, so it's not specifically limited to companies. So if it's a trust that has a certain trade, they can also make use of this provision, we believe.
So is that for the residential, or for the renewable energy business portion?
That would be for the business portion. So let's say we have a client and they have some sort of trade running in a trust. It's not necessarily residential or the letting of residential property. So let's say there's for instance, maybe they have franchises running in a trust or something like that. So it's a legitimate business.
Yeah, I know.
So they should also then be able to use this.
They should, because the legislation will refer to a person or a taxpayer, which will then include everything else. I see there's a question from Diane McGregor. She just wants some clarity around the 1 million rand / 80% assessed loss that will be able to be utilized. Diane, the legislation, the interaction between the 1 million and the 80% is that it's the higher of 1 million rand or 80% of the taxable income. So you have to do a calculation. Taxable income, 80% of that gives you a figure, and then compare that to the 1 million. Whichever is the higher of that, you're able to utilize against the or that amount of the assessed loss that can be rolled forward. Johan, this is actually best explained through practical examples. I know Baker Tilly also distributed something last year that has some nice examples. I think that might have been from the explanatory memorandum. Maybe it makes sense to just circulate that to this audience as well. Because it's something you have to go and think about every time, because it's maximum 1,080% taxable income. It's always a bit of a calculation. So maybe it's worthwhile just distributing that again.
Definitely. So I think the example Peter is referring to, it gives 5 nice examples of what happens depending on what your taxable position is and what your assessed loss is. Is it over 1 million? Is it under 1 million? So it gives some nice examples of how to treat each scenario.
And this is for going into a provisional tax next year. This is super important, because provisional tax is a challenge as is, especially in the farming and manufacturing industry, where most of your figures you only get after year end. So going to provisional tax next year, this is going to be absolute chaos. So pay careful attention to this. The 27% is nice, but it comes with this downside of the losses. So tread carefully around that, please.
Definitely. I must say, running into this February deadline for provisional taxes, I think all our taxpayers will agree it's already a challenge. I think especially next year, this time is going to be even bigger.
No, I couldn't agree more. Yeah, it is. Johan, I don't see any other questions unless there's anything else from your side. That's my contribution for the day.
I just have one last question. So I think one of the announcements or reliefs the minister also announced was in the form of diesel rebates. And they wanted to extend that to food manufacturers.
Yes, quite.
So my question was, I don't know the exact detail on that. So would that go towards generation of electricity? So if they have to put diesel in their generators in order to continue food production?
I think that's going to be the case, because it speaks to especially the food security element of it. So everybody else that runs a shop that sells books and stationery, so will object, why not extend that to us? Because our business is also around that. But what appears to be the case is that it's related to food security and the continuous supply of substance to people. So that's the assumption now. But it's very vague statements that they've made at this stage. So we don't know whether you go fill your can for diesel generation for ordinary shop, whether that's going to be applied. I think you'll likely have to be certified specifically as a food manufacturer, a specific SIC code, and then only you'll be able to claim it. But again, vague statements at this stage, we don't know, which is really frustrating.
Yes. I know a lot of the retailers like Pick n Pay and Woolworths came out yesterday and they expressed their unhappiness with how vague it is, because they also believe with the amounts they're having to spend to keep their stores open, they should also
Pick n Pay spent 350 million rand last year on diesel for generators. It's a staggering amount. So if we just strip out the levies out of that, it'll probably half that account for them. So I completely appreciate the frustration with the vagueness of the statements at this stage. My hope is that usually in July, but I hope given all of these uncertainties that they accelerated, and then we think that we'll at least have 2 batches worth of legislation. Leave the minor things until July, but these that are really pertinent now, that needs to get answered now, that we'll have in March or April, the first batch that already addresses now. We have seen it in the past, and I hope it's similar this year, so we can get some sort of certainty.
Okay, no, agreed. It is. I know it's
excellent.
This period, as you say, it is tough, because in the one sense there is some hope, but in the other sense there's also a lot of uncertainty about the details.
Yeah, no, quite. No, it's terribly frustrating, but it's the cards that we've been dealt with. So yeah, as I mentioned, I think we're resilient and we'll get through it.
Yes. Okay. So Peter, I don't see any new questions that have come through. So I'd just like to thank everyone for attending, and I'd like to especially thank you for your time and giving us this presentation, especially for handling the questions.
Yeah, no problem at all. If there's anything that pops up, please let us know, either through John or contact us directly. I just had a quick look at there's a lot of people, 200+ people attended, so I'm sure there might be some questions that weren't asked on the forum now. Send the questions through, we'll try to address those as best we can.
Okay, right. Thank you, everyone. Thanks, Peter. Have a good day.
Everyone, also Thanks.